Hello my friends, this is Doug Fabian. Welcome to my weekly ETF report. Today is Thursday, September 17th, 2015. Thank you for joining me. As always, three things to talk about. Let's begin with the Federal Reserve. Today was the Open Market Committee and its decision on interest rates, and the decision was not to raise rates. The initial reaction in the stock market was a relief rally, but stocks ended up closing down slightly on the day. What really matters is what the Fed said in their statement, and they used these words. They did not raise interest rates because of declining global economic conditions. There's no way to put a positive spin on declining global economic conditions. So the Fed's worried about what's going on in the rest of the world. So I thought what we should do is take a trip around the world and look at some specific exchange-traded funds and see how they're doing. Let's begin with the S&P 500, ticker symbol SPY. You can see that the market had its big decline into the lows of October 24th. We've rallied somewhat here, but we've stalled out, and we're about 4% below the 200-day average at this particular point in time. But the S&P 500 chart is looking not bad. Looking at the next chart, we have EFA. This is Europe, Australia, and the Far East. But you can see that this particular chart is further below its 200-day average, really reflecting the declining global economic conditions. Moving further, we have the emerging markets, and their chart looks worse than the developed markets, further below its 200-day average. And then looking at Latin America, it's clearly in a bear market. And then lastly, looking at China, it is also clearly in a bear market. So what we have here is a situation where we're going to be needing to watch what happens in the weeks ahead and whether or not so much the economic activity in the US, but what's happening globally is going to dictate what happens between now and the end of the year. I'm still of the opinion that we could revisit the market lows, but clearly we're still below the 200-day averages, and so therefore let's stand aside. Now let's talk about the third subject I want to discuss today, and that is the PR hit that exchange-traded funds are taking in the wake of the August 24th mispricing of exchange-traded funds intraday. Now just to remind you, on that date, stocks traded down sharply early in the morning of August 24th. Some exchange-traded funds fell as much as 30% below their individual indexes for about 5 minutes. And then, after the first half hour of trading, ETFs were trading normally once again. There's a lot of negative press on exchange-traded funds now, talking about how they're not safe and they don't work, blah, blah, blah. The fact of the matter is there was a perfect storm that developed that caused this mispricing of exchange-traded funds. And many individual investors were hurt using market orders, market stop-loss orders, or because they jumped on their computer and panic sold in the morning of August 24th. So just because these things happen doesn't mean that exchange-traded funds are inappropriate investment vehicles. And of course, nothing happened to us because we were out of the market on August 24th. So I'm going to be writing more about this in my newsletter, but I just want to continue to let you know I'm still a huge advocate of exchange-traded funds, and we're going to get some great buying opportunities in the weeks and months ahead. This is Doug Fabian. Thanks so much for joining me today.